Disclaimer: China just moved $8 trillion. And not in theory, not in headlines, not as a forecast, but in real assets, real reserves, real trade positioning, and real institutional capital. A number so large it exceeds the entire economies of Germany and Japan, and even the combined GDP of Africa. And what makes this terrifying is not the size of the move, but the intent behind it. This was not diversification, not routine reserve management, not China rebalancing, but a coordinated multi-year economic repositioning that only makes sense if the objective is total economic confrontation with the Western financial system, rather than coexistence within it. The most dangerous part is that this move is not new in history, not unprecedented, and not unpredictable, because the exact same structure has appeared 3 times before in modern recorded history, following the same sequence, exploiting the same weaknesses, and ending with the same result every single time. Rising powers never announce economic war, because announcing it would neutralize its effectiveness. Instead, they prepare silently, methodically, patiently, and by the time the dominant power realizes what is happening, the math is already closed, the leverage already locked in, and the outcome already unavoidable. The West is making the same mistake every declining empire makes, assuming this is normal behavior. Another scary headline, another China story that analysts can debate while nothing fundamentally changes. And that complacency is precisely what guarantees the damage will be catastrophic. There is a pattern, not ideological, not political, but structural, a 4-stage cycle that repeats across centuries, continents, and civilizations, independent of technology or culture, governed only by leverage, dependency, and timing. We are not early in that pattern, not approaching it, not watching it form, but already deep inside it, past the point where reversal is easy and well beyond the phase where warnings still sound theoretical. The pattern always begins with deep interdependence, where 2 economic powers become tightly intertwined through trade supply chains, capital flows, and consumer dependence, creating the illusion that conflict is impossible because the cost would be too high for both sides. Trade explodes, profits surge, consumers benefit, politicians praise cooperation, economists publish papers declaring the end of economic conflict, and everyone involved begins to believe the relationship is permanent, stable, and self-enforcing. It never is. Beneath the surface, asymmetry forms quietly, with one side saving accumulating reserves, building redundancy, and preparing for disruption, while the other side spends, borrows, deepens dependency, and assumes stability will continue indefinitely. The dominant power grows comfortable and complacent, while the rising power grows strategic, patient, and deliberate. Then comes the most dangerous phase of all, the one almost everyone misses, where the rising power begins repositioning without confrontation, without announcements, and without visible aggression, smiling at summits, signing agreements, and maintaining the appearance of cooperation while quietly building alternatives behind the scenes. Parallel systems emerge, backup routes are constructed, settlement mechanisms are duplicated, exposure is reduced, paper claims are converted into hard assets, and separation is prepared for long before it is publicly acknowledged. This phase looks exactly like peace, which is why it works. The final stage arrives when the rising power weaponizes the dependency it's spent decades helping to build, not emotionally, not impulsively, but deliberately, exploiting leverage at the moment when the dominant power has the fewest options and the highest cost of response. The collapse is not military, but economic, and that makes it worse because you cannot counterattack effectively, cannot mobilize your way out of it, and cannot reverse it once confidence breaks. This has already happened. At the start of the 20th century, Britain was the undisputed global superpower, controlling a quarter of the planet, issuing the world's reserve currency, clearing global trade through London, and sitting at the center of international finance with an aura of permanence that seemed unshakable. Germany was rising rapidly, industrializing at extraordinary speed, building factories, exporting manufactured goods, accumulating capital, and integrating deeply with the British economy through trade relationships that made war seem irrational and impossible. British newspapers wrote about eternal peace through commerce, politicians dismissed conflict as outdated, and economists insisted economic integration had made war obsolete. Behind the scenes, Germany was doing something very different, systematically reducing dependence on Britain, slashing pound holdings, accumulating massive gold reserves, and building alternative trade networks across Eastern Europe and the Ottoman sphere, creating a parallel economic ecosystem Britain failed to notice. By the time British leaders realized what was happening, it was already too late, because German financial officials were openly discussing how to destabilize the British financial system using capital flows, gold recalls, and liquidity shocks rather than armies. When war broke out in 1914, the financial attack landed immediately, freezing British assets, draining liquidity, nearly collapsing the Bank of England within days, forcing Britain to suspend gold convertibility and beg the United States for emergency financing. Britain won militarily, But economically, the damage was irreversible. The pound never recovered, and within decades, the dollar replaced sterling as the world's reserve currency, completing the pattern. The same structure reappeared after World War II between the United States and Japan, when America rebuilt Japan, integrated it into global trade, and framed the relationship as a model of cooperation, while Japan quietly accumulated enormous dollar reserves and converted paper claims into real assets. Americans interpreted Japanese purchases of real estate and companies as investment, but in reality it was positioning, leverage consolidation, and preparation for currency influence. By the mid-1980s, Japan had sufficient leverage to reshape global currency markets, forcing dollar devaluation through the Plaza Accord and preparing for a post-American economic order in Asia. In 1987, coordinated selling by Japanese institutions triggered the largest market crash in modern history at that time, nearly breaking the system and proving that economic warfare could destabilize even the strongest financial empire without a single military engagement. China studied that lesson carefully. The most recent example came after the Cold War, when Europe integrated Russia into its economy, built its industrial base on Russian energy, and convinced itself that dependency guaranteed peace. Russia spent 2 decades accumulating reserves, reducing dollar exposure, increasing gold holdings, and building alternatives to Western financial infrastructure. So when sanctions hit in 2022, Russia absorbed the shock while Europe collapsed into inflation, industrial shutdowns, and long-term economic damage. The pattern worked again. China has been watching all of this, learning from every example, refining the strategy, and executing it at a scale never seen before. Between 1990 and 2010, the foundation was built as China was integrated into global trade. Manufacturing was outsourced, technology transferred, supply chains consolidated, and trade volumes exploded from billions to trillions. China became both the world's factory and America's largest creditor, a position that created wealth for everyone involved and convinced policymakers the relationship was permanent. Then came the accumulation phase, where China didn't merely store dollars, but built alternatives, new trade routes, new banks, new payment systems, and new infrastructure spanning continents, all framed publicly as development, but designed privately as preparation. Now, in the last 24 months, the repositioning has accelerated beyond anything seen before, with $8 trillion restructured across reserves, assets, trade exposure, and institutional capital. Treasury exposure has been reduced, gold accumulation has surged, currency swap agreements have expanded, payment systems have scaled rapidly, strategic resources have been stockpiled, and state-owned capital has been ordered out of Western markets. This is not speculation, not theory, not fear-mongering, but execution. And that brings us to the most dangerous moment in the entire cycle, the calm before the trigger, because when stage 4 begins, it does not announce itself, it detonates. The collapse never begins with chaos, panic, or a single dramatic headline, because stage 4 always starts with coordination that looks like policy, regulation, and normal market behavior, until the system begins to fracture in places no one is watching. China does not need to act emotionally, aggressively, or impulsively, because economic warfare rewards patience. And when the trigger is pulled, it is pulled once, deliberately, and at the moment when every response option produces damage. The first strike is financial, because finance moves faster than politics and spreads faster than fear. And China's remaining U.S. Treasury holdings give it the ability to shock the global bond market instantly if they are sold in a coordinated wave rather than gradually. When that happens, interest rates do not rise smoothly or predictably, but spike violently, breaking debt markets, freezing credit, and forcing the United States into an impossible decision between allowing rates to rise and triggering an immediate depression or printing money at scale and destroying the currency. There is no good option, and that is the point, because stage 4 is not designed to win cleanly, but to force collapse through contradiction. At the same time, supply chains tighten not through dramatic embargoes or public bans, but through friction that looks bureaucratic rather than hostile. Export licenses, processing delays, environmental inspections, regulatory reviews, and selective restrictions that quietly produce shortages, panic buying, and price spikes. Governments call it inflation, corporations call it disruption, and the public is told it is temporary, but in reality it is structural, intentional, and irreversible once confidence begins to fracture. The final move is not destruction, but replacement, because China does not merely break the system, but offers an alternative at the exact moment the old one begins to fail. Trade settlement without dollars, payments without SWIFT, currency systems backed by commodities rather than promises, and preferential access for early adopters appear not as ideology, but as survival tools for countries caught in the middle. Nations do not switch systems because they want to, but because the existing system stops functioning under stress. And when liquidity vanishes, survival overrides loyalty. This is how reserve currencies actually die, not in a single dramatic moment, but through cascading loss of confidence triggered by pressure, fragmentation, and the sudden availability of a viable alternative. The West comforts itself with familiar lies, that China needs Western consumers, that the dollar is too entrenched to be replaced, and that American adaptability will neutralize the threat. History shows otherwise, because Germany needed British trade in 1914, Japan depended on American consumers in 1987, and Russia relied on European energy revenue in 2022. Yet all three weaponized dependency when leverage peaked. Economic interdependence does not prevent conflict. It creates the conditions for economic warfare, and the deeper the dependency, the more devastating the leverage when it is finally used. The dollar's dominance is not guaranteed by size or history, but by trust, restraint, and discipline. And those foundations are eroding under exploding debt, weaponized sanctions, and relentless monetary expansion. Every frozen reserve, every sanctioned bank, every confiscated asset sends a clear message to the rest of the world that alternatives are no longer theoretical, but necessary. Those alternatives now exist, not as experiments, but as functioning systems, processing real transactions at scale, quietly draining relevance from the old architecture. The most dangerous delusion is the belief that the response will be fast enough, because supply chains take years to rebuild. Manufacturing ecosystems take decades to recreate. Debt cannot be unwound quickly, and dependency cannot be reversed on command. When the system breaks, it breaks unevenly, collapsing some sectors instantly while others decay slowly, and a small number surge as conflict, scarcity, and reshoring reshape incentives. Defense spending explodes, domestic manufacturing becomes strategic, energy independence shifts from environmental policy to national survival, food security turns agricultural supply into a geopolitical asset, and hard assets outperform paper claims as confidence erodes. This is not a call for panic, but a demand for positioning. Because the people who lose are not the uninformed, but the complacent, the ones who believed the system would protect them because it always had before. History punishes that belief mercilessly. Dutch merchants believed tulips were stable, British investors believed the pound was eternal, Japanese speculators believed land never falls, and European manufacturers believed energy dependency was safe. Every one of them was wrong. The pattern does not respond to belief, hope, or moral arguments, only to leverage, preparation, and timing. And right now, all three favor China. The leverage has already shifted, the preparation is visible, and the timing window is narrowing, which means what follows is not a question of if, but when. The $8 trillion have already moved, the repositioning is already underway, the deadline is visible, and the final phase will not wait for consensus or comfort. What comes next will redefine markets, currencies, and global power for decades, and those who recognize the pattern early will not merely survive the transition, but benefit from it. This is not prediction, speculation, or fear, but pattern recognition grounded in history, structure, and observable execution. If you want to understand exactly which sectors break first, which assets preserve value, and how this unfolds step by step as stage 4 accelerates, then make sure you're connected. Like the video, subscribe to the channel, and turn on notifications, because what comes next will determine who stands and who falls when the system finally shifts. The collapse is not optional. Your response is,